Today, we're taking a look at a situation that's creating a lot of waves. CoreWeave, ticker CRWV.
A lot of volatility there.
A ton. The stock's currently sitting right around the $76 mark, and that's after a really sharp, unsettling drop.
And if you look online, the general sentiment, it's just pure panic.
It really is. But the research we've been digging into tells a completely different story. I mean, it's radically different from all that headline noise.
The consensus from the data is that this whole movement is just misplaced. It's a classic bear trap, really, playing on fear.
Okay, let's unpack this.
Yeah.
Our mission today is to look at the fundamentals and figure out if this dip is a real problem, or if, like some of this compelling analysis suggests, we're staring at the single greatest buy-the-dip opportunity of 2026.
It's absolutely critical to filter out that short-term motion, especially with a company on the cutting edge of AI.
We need to figure out why Wall Street might be getting this so spectacularly wrong right now.
Well, you see market makers driving a narrative based on, just the daily price chart.
Yeah.
But when you look at the actual business, the contracts, the stock price just doesn't capture the strength that's there.
And that's where we have to start. The separation between that noise and the reality. So what actually caused the sell-off? The stock closed at what, 76, 86?
Yeah, down about 3% in one day, $2.50 a share.
So this is segment one. We're looking at the immediate bear trap. The big worry, the elephant in the room that the short sellers are waving around is capital expenditure.
DevEx. It's always CapEx.
The narrative is simple. CoreWeave is spending way too much money, just piles of it, on NVIDIA chips. It looks like they're just burning cash.
And this is the first, critical mistake in that bearish thinking. In almost any other industry, high CapEx is a red flag. It's speculation.
You're building something and just hoping customers show up later.
Exactly. But CoreWeave is a completely different model. The analysis shows this expenditure isn't burning cash speculatively. It's the cost of manufacturing a product for guaranteed income.
So every dollar they spend on a chip
Is already sold. It's already earmarked for a client that has signed a contract.
So they aren't buying inventory and hoping for a sale. They're literally fulfilling committed purchase orders.
Precisely. They are investing for obligated fulfillment. The spending is directly tied to the revenue they've already secured. It's just the cost of doing booming business.
That reframes the entire argument. It's not a sign of financial distress at all.
Not in the slightest.
Okay, so if the CapEx fear is just a red herring, that brings up the next question. Why are they the ones getting these massive contracts over, the giants like AWS or Google Cloud?
And that gets us to their real advantage, their moat.
Here's where it gets really interesting. CoreWeave doesn't just call itself a cloud company. They're an AI hyperscaler.
And that's not just some marketing buzzword. It speaks directly to their infrastructure.
Right. Their advantage is specialization. Think about the legacy cloud providers.
They're generalists. They have to be. They have a mix of servers, old ones, new ones, CPU, GPU, to do everything from hosting a website to running a spreadsheet.
So their whole setup is a compromise.
It has to be.
Yeah.
But CoreWeave is built from the ground up 100% for modern GPU acceleration, for high-performance, low-latency AI training.
Which requires specialized networking, specialized cooling.
Things that the legacy guys just can't pivot to quickly. It's like bringing a Formula One car to a city bus route. They simply can't compete on these very specific high-demand tasks.
And that's why the giants are paying up. That specialized infrastructure translates directly into an almost unbelievable backlog of business. The analysis puts it at $55 billion.
A massive number.
Wait, $55 billion? That's a staggering figure. Are we sure that's solid? I mean, how much of that can be canceled if the AI demand slows down?
That is the crucial question. And according to the reports we're looking at, this is described as guaranteed future money.
So not just a sales projection.
No. These are largely fixed, multi-year contracts. They come with extremely high penalties for early termination. So this revenue must be fulfilled. Very few companies on Earth have that kind of revenue certainty.
And you see the proof in their partners, right?
Yeah, absolutely. You don't get massive contracts from Microsoft, or even more importantly, from OpenAI, the people behind ChatGPT, unless your tech is absolutely essential.
They're betting their entire development roadmap on CoreWeave's capacity.
Exactly. So that $55 billion validates the tech, the scarcity, and their pricing power all at once. If we connect this to the bigger picture, this moat is basically impenetrable right now.
Okay, so the spending is healthy, the moat is real and fortified by $55 billion in contracts. Now we have to dive into the cold, hard facts the market seems to be completely ignoring.
The ignored financial deep dive.
Let's start with Q3 revenue. It was reported at $1.36 billion. Now, the analysis stresses that for a company at this stage, that represents just massive year-over-year growth.
The velocity of the scaling is the real story there. But growth is meaningless unless you have profit. And this This is probably the most shocking part.
Right.
Their adjusted EBITDA, that's their operational profitability, was $838 million in Q3 alone.
Okay, so when you run those numbers,
Mhm.
what does that work out to in terms of margin?
It's an exceptionally high margin of 61%.
61. Let's put that into context for you.
Most high-growth tech companies, especially ones buying billions in chips, they'd be lucky to see margins in the 30s, maybe low 40s.
61% while scaling this aggressively it's almost unheard of. It just screams pricing power. It says they have absolutely no competition for what they do.
And that profitability fundamentally changes the conversation around their cash flow and their stability. They can self-fund a huge portion of their own build-out.
Which makes the current valuation look, well, ridiculous.
Absolutely ridiculous.
Yep.
The stock is trading at a $38 billion market cap today.
Compare that to its previous high of $187 a share. We're looking at a discount of nearly 60% from what the market was willing to pay not that long ago.
It's trading like a company that just missed its earnings, or lost a major client, or saw its profits collapse.
But the data shows the complete opposite. 61% margins, huge growth, $55 billion in guaranteed contracts. The disconnect is staggering.
It really is. The research suggests the emotional market is completely missing the foundational story here.
All right, let's shift gears. Segment 4. Technical analysis and investment strategy. We need to move from the fundamentals to what the charts are telling us.
Okay, so from a purely technical view, the analysis reports the stock is, and I'm quoting here, screaming oversold.
Meaning the selling pressure has pushed the price way below where it should be.
Exactly. The panic meter is flashing deep red, which for a long-term investor should be flashing green lights. The analysis identifies $75 as the critical support level, the line in the sand.
Why 75 specifically?
It aligns with some key long-term institutional moving averages. It's a psychological level, but it's also a mathematical pivot point for technical buyers. This is where big funds often step in to defend their positions.
And we actually saw that happen, right? After it dipped towards 76, there was a quick bounce in after-hours trading.
Back up to $77.99, buyers jumped in almost immediately to defend that line. It suggests the $75 floor is strongly protected.
So what does this all mean for you, the listener, trying to see past all this panic?
Well, the strategy laid out in the research is pretty straightforward.
Based on the fundamentals and the inevitable correction of this valuation disconnect, the price target for 2026 is between $125 and $150.
Which from the mid-70s is a very compelling return as the market slowly wakes up to the reality of those margins and that guaranteed cash flow.
So the short-term strategy is what?
Definitive. As long as the stock holds above that $75 support, this current zone is what the analysis calls a golden accumulation zone.
An area to build a position while capitalizing on this short-sighted panic?
Exactly. You're taking advantage of the market reacting only to the technicals, not the fundamentals.
When you put it all together, foundational AI company, massive guaranteed revenue, incredible 61% profit margins, trading at a 60% discount, and hitting an oversold signal right at a major support line, that's the entire bull case.
Let's bring it all home. The final synthesis here is that CoreWeave isn't just a player in the AI boom. They're a foundational element. They're building the backbone of the AI revolution.
They have the specialized gear the giants need right now and the $55 billion in contracts to prove it.
That's the core thesis. Don't let these short-term emotional red days scare you out of what looks to be a very green future, a future that's backed by a $55 billion backlog.
Volatility is just part of the game in these high-growth sectors, but the fundamentals, like a 61% margin, they rarely lie.
The analysis we've seen literally treats this drop to $76 as a gift. It suggests the market panic is masking long-term guaranteed value.
So the final thought for you to take away is this. What unexpected gift does the market sometimes offer when short-term panic takes over and the price moves so violently against the financial reality?
Perhaps the greatest gift it offers is the chance to buy guaranteed value